$500,000. For millions of people approaching retirement, this number represents freedom, security, the finish line. The hypothesis is elegant, simple. At a 4% withdrawal rate, you pull $20,000 per year. Live modestly. Your principal remains intact. You never work again. It's the dream sold by 1,000 financial blogs, validated by retirement calculators, endorsed by the 4% rule, born from historical data. But here's what the calculator doesn't show you. What happens when you stress test this hypothesis against reality? When you introduce the variables that actually govern your financial survival, structural inflation, custodial risk, black swan health events, and the silent erosion of purchasing power. This is not fear-mongering. This is forensic analysis. We're going to run the numbers that retirement planners want. We're going to examine 3 critical risk factors that can destroy a $500,000 retirement portfolio. And we're going to do it with institutional-level rigor. Imagine you retire today, February 2026. You're 55 years old. You have $500,000 in a high-yield savings account earning 4.5%. You plan to withdraw $20,000 annually. You need this money to last 30 years. Question, will it? On paper, yes. Run it through any retirement calculator and you'll see your balance staying positive through 2056. But paper doesn't account for stress variables. Let's introduce variable 1, inflation. Not the inflation the government reports, the inflation you actually experience. The Consumer Price Index tells you inflation is running at 2 to 3% annually. But housing costs? Up 6 to 7% per year in many markets. Healthcare? Even faster. The things that consume the majority of a retiree's budget inflate at double the official rate. This is the phenomenon called asset price inflation, and it's the first crack in the $500,000 fortress. Your savings account pays 4.5%, but if your real cost of living inflates at 6%, you're experiencing a negative real yield of 1.5% annually. Your money isn't growing, it's shrinking. In purchasing power terms, you're losing ground every single year. This is the silent erosion, the invisible tax on static capital. And over 30 years, it's catastrophic. Run the stress test with 6% real inflation, and your $500,000 doesn't last 30 years. It runs dry in year 19. You're 74 years old. And you have nothing left. But it gets worse because we haven't even introduced market volatility yet. Even money in safe, high-yield savings faces structural risks. What happens when the bank holding your deposits faces liquidity constraints? When interest rates drop overnight due to central bank intervention, March 2023, Silicon Valley Bank collapses in 48 hours. Signature Bank follows, billions in deposits frozen. The FDIC insures $250,000. You have $500,000. What happens to the excess? This is custodial risk. The risk that the institution holding your wealth becomes inaccessible, insolvent, or operationally frozen during a crisis. If your entire net worth sits in one bank, in one country, in one currency, you have what institutional investors call single point of failure risk. You are geographically and structurally concentrated. Smart money doesn't do this. Pension funds, endowments, family offices, they diversify jurisdictionally, multiple banks, multiple countries, multiple asset classes, because they understand that systems fail. Now let's add variable 2, a market shock, not in stocks. You're in savings, but the bank slashes interest rates to 0.5% during a crisis. Suddenly, your 4.5% yield vanishes. Your withdrawal rate relative to your returns becomes unsustainable. Combine negative real yields with slashed interest rates and continued withdrawals, and the math turns brutal. The portfolio doesn't slowly erode. It collapses. This is sequence of returns risk in a savings context, and we haven't even discussed the third variable yet, the one that destroys more retirement plans than inflation and market crashes. Combined, the power law of healthcare costs. The first risk factor we need to examine is the one that operates in complete silence. You won't feel it day to day. You won't see it in your bank statement. But over decades, it's absolutely lethal. We're talking about the erosion of purchasing power through negative real yields. And to understand this, we need to distinguish between 2 types of inflation that govern your actual financial reality. The government publishes the Consumer Price Index, February 2026. The CPI sits around 2.5%. The Federal Reserve celebrates inflation is under control. Mission accomplished. But here's the problem. The CPI measures a basket of goods weighted toward things that don't dominate a retiree's budget. It includes electronics that get cheaper every year, clothing, general merchandise, things that deflate or stay flat. What the CPI dramatically underweights are the 2 categories that consume 60 to 70% of a retiree's spending, housing and healthcare. Let's look at housing first. Not the Case-Shiller Index, not national averages. Let's look at what it actually costs to maintain a modest lifestyle in a mid-tier American city. From 2010 to 2025, Median rent in cities like Austin, Phoenix, Nashville, and Boise increased between 70% and 110%. That's not 2% annual inflation. That's 6 to 8% compounded annually. Property taxes, insurance, homeowners association fees, all tracking the same trajectory. Even if you own your home outright, the cost of maintaining it inflates at rates that dwarf the official CPI. Now, healthcare. This is where the divergence becomes grotesque. In 2010, the average annual healthcare expenditure for someone over 65 was approximately $11,000. By 2025, that number exceeded $18,000. That's a 63% increase in 15 years, or roughly 4.2% annually. But that's just the average. Medicare Part B premiums have increased 5 to 6% annually. Supplemental insurance, 6 to 7%. Prescription drugs for chronic conditions, some have doubled or tripled in price. And we haven't even introduced long-term care yet. The average cost of a private room in a nursing facility now exceeds $108,000 per year. Assisted living averages $54,000 annually. Home health aides cost $30 to $35 per hour. These aren't luxury services. These are baseline necessities for managing aging. And they inflate at 5 to 8% annually, while the CPI reports 2.5%. So let's return to our stress test. You have $500,000 earning 4.5% in a high-yield savings account. You withdraw $20,000 in year one to cover living expenses. If we use the CPI inflation rate of 2.5%, your withdrawal needs to increase to $20,500 in year two, $21,000 in year three. Over 30 years, your final withdrawal would be $41,845. Run that through a calculator, and your money lasts. But now let's use real inflation, the inflation you actually experience in housing and healthcare. Let's be conservative and call it 5.5% annually. Year two, you need $21,100. Year three, $22,260. By year 10, you need $33,142 just to maintain the same purchasing power you had in year one. Your balance is earning 4.5%, but your withdrawal requirements are growing at 5.5%. You're in a negative spread of 1% annually. And that 1% compounds against you. By year 15, you're withdrawing $42,000 annually. Your balance has dropped to $380,000. You're burning through principal at an accelerating rate. By year 20, you need $55,000 per year just to maintain purchasing power. But your account balance is down to $210,000. You're withdrawing 26% of your principal annually. Year 25, the money is gone. You're 80 years old, and you have nothing. This is the mathematical reality of negative real yields. When your cost of living inflates faster than your returns, you're not preserving wealth. You're slowly liquidating it. And here's what makes this particularly insidious. It happens so gradually that you don't notice until it's too late. Year 1 to year 5, everything feels fine. You're still drawing $20,000 to $25,000 annually. The balance is still over $450,000. There's no crisis, no alarm bells, but the erosion is happening beneath the surface. Every year, your dollar buys less housing security, less healthcare access, less buffer against emergency. By the time you reach year 15 and realize the math has turned against you, you've lost optionality. You can't go back to work at 70. You can't rebuild the principal. You can only manage the decline. This is why institutional investors obsess over something called the real rate of return. Not the nominal rate, the real rate. Returns minus inflation. If you're earning 4.5% nominal but experiencing 5.5% real inflation, your real return is negative 1%. You're moving backwards, and over multiple decades, moving backwards 1% per year is catastrophic. So what's the alternative? How do you escape negative real yields? There are only 3 options. 1, increase your nominal returns. Move out of savings into assets that outpace inflation, equities, real estate, inflation-protected securities. But this introduces volatility and risk. 2, decrease your inflation exposure. This is where geographic arbitrage enters the equation. If you can relocate to a jurisdiction where housing and healthcare costs inflate at 2 to 3% instead of 6 to 8%, you've just bought yourself an extra decade of runway. 3, introduce active cash flow. Even $500 to $1,000 per month in side income completely changes the math. You're no longer drawing down principal as aggressively. The portfolio has breathing room. But if you do nothing, if you simply park $500,000 in a savings account, withdraw from it annually, and assume the 4% rule will save you, the math is unforgiving. You're not retiring. You're entering a 20-year liquidation process. And by the time you realize it, there's no way out. This is the silent erosion, the invisible tax on static capital. The risk factor that doesn't announce itself with market crashes or headlines. It just quietly, methodically destroys your purchasing power, 1 year at a time, until there's nothing left. Now we move from the slow erosion to the sudden shock. From the risk that compounds over decades to the risk that materializes in 48 hours. This is structural fragility, the vulnerability embedded in the very systems designed to keep your money safe. Let's start with a scenario. It's a Thursday morning in March. You're checking your bank account online. You have $500,000 sitting in a high-yield savings account at a regional bank. Everything looks normal. By Friday afternoon, the bank is in receivership. The website is frozen. The mobile app displays an error message. Your money is inaccessible. Not gone, inaccessible. There's a difference. This isn't a hypothetical. This is exactly what happened to depositors at Silicon Valley Bank on March 10, 2023. SVB was the 16th largest bank in America. It held over $200 billion in assets. It served thousands of businesses and individuals. On Wednesday, it was operating normally. By Friday, it had collapsed. The trigger was a bank run. Depositors attempted to withdraw $42 billion in a single day. The bank didn't have the liquidity. California regulators seized it. The FDIC took control. Now here's the critical detail that most people missed. The FDIC insures deposits up to $250,000 per account per institution. If you had $500,000 at SVB, half of it was uninsured. In the immediate aftermath, that uninsured $250,000 was frozen. You couldn't access it. You couldn't transfer it. You couldn't withdraw it. It sat in limbo while regulators determined how much of it would be recoverable. The government eventually made depositors whole, but that decision took days, and it was a political choice, not a guaranteed outcome. In previous bank failures, uninsured depositors have taken losses of 30 to 50%. This is custodial risk, the risk that the institution holding your wealth becomes operationally dysfunctional, legally seized, or financially insolvent. And it's not limited to bank failures. Let's examine the 2008 financial crisis through this lens. September 2008. Lehman Brothers collapses. Credit markets freeze. Money market funds, considered ultra-safe, begin breaking the buck. The reserve primary fund, which held Lehman debt, sees its net asset value drop below $1 per share. Investors panic. They try to redeem, but the fund implements a redemption freeze. Your money is trapped. For weeks, you can't access it. When redemptions finally process, you receive 99 cents on the dollar. A 1% loss doesn't sound catastrophic until you realize it's on money you thought was risk-free. Or consider Cyprus, 2013. The government, facing a banking crisis, implements capital controls. Bank accounts over 100,000 euros are subjected to a bail-in. Depositors lose 47.5% of their uninsured balances overnight. Not through inflation, through direct confiscation. You might say, that's Cyprus, that's Europe, that won't happen in America. And you're probably right, probably. But the legal framework for bail-ins exists in the United States. It was established under the Dodd-Frank Act. Title II of Dodd-Frank gives the FDIC the authority to impose losses on uninsured depositors during the orderly liquidation of a systemically important financial institution. It's called the Orderly Liquidation Authority. Has it been used? No. Will it be used? Unknown. But the mechanism exists, and during a systemic crisis, when political pressure is immense and taxpayer bailouts are politically toxic, it's a tool that sits on the shelf. This is what institutional investors mean when they talk about counterparty risk and custodial risk. They understand that the safety of their capital depends not just on the numbers in their account, but on the operational integrity and legal protections of the institution holding those numbers. So what do? They diversify jurisdictionally. A family office with $50 million doesn't keep it all in one bank. They spread it across 5 banks. They hold accounts in multiple countries. They maintain relationships with Swiss banks, Singaporean banks, Canadian institutions, not because they're trying to evade taxes or hide money, because they understand that no single system is immune to failure. Geographic diversification is risk management, but you, with $500,000, probably don't have that option. Setting up foreign bank accounts requires significant capital minimums, legal structuring, tax reporting complexity. It's not accessible to most retail savers, so your $500,000 sits in one institution, in one country, under one regulatory regime. And that creates concentration risk. Now let's layer in another structural vulnerability. Liquidity constraints during market stress. Your high-yield savings account advertises liquidity. You can withdraw anytime. No penalties, no restrictions. That's the promise. But that promise holds only under normal market conditions. During a crisis, liquidity evaporates. March 2020, COVID pandemic triggers a market crash. Credit spreads blow out. Corporate bond markets freeze. Even treasury markets, the most liquid in the world, experience dysfunction. Banks, facing their own liquidity pressures, tighten withdrawal limits. Some implement daily withdrawal caps. Others delay large transfers for verification purposes. The liquidity you thought you had becomes conditional. This is the difference between legal liquidity and practical liquidity. Legally, you can access your money. Practically, the system imposes friction that slows or prevents access during the exact moment you need it most. And here's where the real danger emerges. If you need to withdraw funds during a crisis, to cover an emergency, to take advantage of investment opportunities, to simply feel secure, you may find that the money, while legally yours, is operationally inaccessible. This isn't theoretical. During the 2008 crisis, Wachovia Bank customers reported multi-day delays on wire transfers. Washington Mutual customers faced frozen accounts during the seizure process. IndyMac depositors waited months for full access to uninsured funds. Now let's connect this to your retirement scenario. You're 55. You have $500,000. You're planning to live off this for 30 years. A financial crisis hits in year 3. Your bank doesn't fail, but it implements withdrawal restrictions to preserve liquidity. You need $25,000 to cover annual expenses. The bank limits you to $10,000 per month. That delay might seem minor, but if you have property taxes due or medical expenses pending, that delay creates a cascade. Late fees, lapsed coverage, forced liquidation of assets at the worst possible time. Or worse, the bank actually fails. The FDIC takes over. Your insured $250,000 is protected, but your uninsured balance, that could take months to resolve. And there's no guarantee of full recovery. You are now facing a liquidity crisis through no fault of your own. The system failed. And you, with all your eggs in one basket, have no backup. This is why institutional money never concentrates. Diversification isn't just about buying different stocks. It's about jurisdictions. It's about ensuring that a single point of failure, one bank, one country, one regulatory system, cannot destroy your entire financial foundation. But most retirees optimize for convenience. They chase yield at a single bank, and when structural fragility hits, they are trapped. Structural failure happens fast. One day you're secure, the next day you're frozen out. Now we arrive at the third risk factor, the one that is statistically inevitable, the one that destroys more plans than inflation and market crashes combined, the healthcare power law. Averages are a lie. Retirement calculators assume you will spend the average of $7,000 a year on health. But healthcare follows a power law. 10% of retirees will spend over $50,000 in a single year. 1% will exceed $250,000. You don't plan for the average. You have to survive the tail risk. Let's make it concrete. You're 62, you have a stroke. You survive, but you need rehab and home modifications. Total out-of-pocket cost, $87,000. In 3 months, you just lost 20% of your remaining principal. Then comes the knockout blow. Long-term care, 70% of people over 65 will need it. Medicare pays $0 for custodial care. The average nursing home now costs $108,000 annually. Assisted living is $54,000. 3 years of care wipes out your entire life savings. This is correlation risk. If a health crisis hits while inflation is high or the market is down, the probability of financial failure exceeds 70%. You cannot diversify your body. You cannot arbitrage cancer. Hoping you won't get sick is not a strategy. It's a gamble. And with a static $500,000, the house usually wins. So what is the solution? We have stressed the $500,000 hypothesis to failure. Now, let's look at the mathematical hedges. There are 2 strategies that actually change the probability of success. Hedge 1, geographic arbitrage. This is the most powerful lever you have. If you relocate to a jurisdiction where your cost of living is 50% lower, whether that's Portugal, Panama, or even rural Tennessee, you effectively double your portfolio. The math is simple. Withdrawing $40,000 a year drains your account in 22 years. But if you lower your burn rate to $18,000 a year through relocation, that same $500,000 lasts 40 plus years. You die with assets remaining. You aren't sacrificing quality of life, you are optimizing your cost structure. Hedge 2. Active cash flow, Barista FIRE. You must generate a small amount of active income to stop the bleeding of your principal. If you work just 15 hours a week, earning $15 an hour, that's $11,700 annually. It doesn't sound like much, but watch the math. Instead of withdrawing $40,000, you only need to withdraw $28,000. That small active income adds 13 years to your portfolio's lifespan. And if you combine these, if you move to a lower cost area and earn $11,700 a year, your withdrawal rate drops to near zero. Your principal doesn't shrink, it grows. You become anti-fragile. The final equation. You have 2 paths. Path 1. You keep $500,000 in a single account. You stay in a high-cost area, you have no active income, you hope inflation stays low, and your health stays perfect. Result? A 70% chance of failure, high stress. A long, slow liquidation ending in poverty. Path 2. You deploy strategically. You use geographic arbitrage to cut costs. You maintain a small active cash flow. You diversify your custody to avoid structural risk. Result, an 85% probability of success. Your wealth grows. You are resilient against shocks. The $500,000 retirement dream is possible, but not by parking money and doing nothing. It works only if you treat your life like a business. Reduce the burn rate, diversify the risks, keep the cash flowing. Do that, and $500,000 isn't just enough. It's freedom. Ignore the math and you aren't retiring, you're just unemployed with a ticking clock. Which equation will you choose?